The Fed has never before this time raised interest rates in the middle of a crisis. And here again, they're talking about another 25 basis points in early May. It doesn't seem like there's much movement at all. And yet we know that Republicans and Democrats don't want to go through another 2011 where the ratings agencies downgrade our debt. So we assume they'll figure it out. We're seeing deposit outflows from the banking system, so that's the private sector, into money market fund and especially treasury securities. So what is that doing? It's actually accommodating spending, government spending. So this could be just a slow-moving crisis, we don't know. But getting into monetary policy, it could be a slow-moving crisis, or are we talking about a hard landing? And I think, the markets are a little bit on pause now, trying to figure out, did the Fed and the FDIC come in and, rescue the banking system from a run on the banks? And so fiscal and monetary policy makers around the world moved into action, and 27% money growth in the United States is one outcome. But the money growth rate started falling pretty rapidly. And over the last 2 years, it's dropped 30 percentage points. We're now down roughly 3%. That's negative on a year-over-year basis. We have never seen a 30 percentage point decline in the growth rate of M2 on a year-over-year basis ever. And we have also not seen negative year-over-year M2 growth since the 1930s. So that was the time of the Great Depression. So we're taking this seriously. JP Morgan's credit default swaps are getting close to where they were in the middle of the COVID crisis. And so that's usually a signal that the economy is going to end up in trouble and that inflation and interest rates will come down fairly dramatically. And so that happened last July. Still, the Fed didn't pay any attention to it, it seems to us. And then in October, we wrote a letter just raising some of the issues or the conflicting evidence out there. We had credit default swaps going up, the yield curve getting more and more inverted. We had commodity prices of all kinds coming down. So that's the early stage of the inflation pipeline. And we just asked the Fed, look, please consider there is conflicting evidence out there. And your votes, it would seem, should not be unanimous to go up 75 basis points at a clip. Two major mistakes that banks made. Both of them actually were very understandable, but they were mistakes nonetheless. And they made those mistakes in the middle of COVID, as the crisis was unfolding. They took a look at the Fed's forecast through the end of this year and saw that the Fed was forecasting that interest rates would go nowhere. Rates went up 20-fold. Deposits flowed out and into money market funds, so out of the banking system, that failure. It was a venture capital funding drought, and basically these startup companies that were banking at Silicon Valley Bank needed to fund their operations, and we can see them now in the commercial real estate market, which from what we're hearing is basically frozen, and we're beginning to see more strategic defaults and fire sale prices anecdotally. So that's a problem. Now, because deposits are still in outflow mode. Most people who take Macroeconomics 101 learn it in that class. And it is that MV equals PQ. So PQ is price times quantity, and that's nominal GDP of the economy. So the production of goods and services in the economy. The other side of that, and these two have to equal, is MV. Well, we know that money supply on a year-over-year basis is going down about 3% year-over-year, our estimate for March. And on a sequential basis, it's going down even more rapidly. So to plug that hole and to figure out what's going to go on here, we need to know what V is. V is the residual value. And if you look at what happened in the first quarter, it looks like nominal GDP was up roughly 7%. We have these numbers, I'm just rounding up roughly 7% on a year-over-year basis. You've got money down 3, so that means velocity was up roughly 10 on a year-over-year basis. basis. Now, you'll notice that the stock market is still up year to date, and we think there are reasons for that. But just back to this hard landing, if money continues down and velocity even flattens out here, then on a year-over-year basis, it's going to be slowing dramatically from 10% in the first quarter to 5 to 7% in the second quarter. And if money is down 4%, well, that doesn't leave much room for nominal GDP growth. So if money is down, let's just say it's down 4%, and velocity is only up 7%, let's say, instead of 10% on a year-over-year basis, which means it's flattened out quarterly. So, interestingly, in learning today that Governors Waller and one other, Bullard, are saying inflation's still too high, we've got to stay tough. I went and looked at their backgrounds, and I think this is true of most people on the Fed. They have no market experience, and therefore I don't think they respect market signals. The surprise to me, though, is they're economists, as many of the people on the Fed are. They're economists, so at least they should be doing this very basic: if is falling and V is threatening to flatten out or fall, what happens to nominal GDP? One of the good things that we did hear during the last week is a new Fed governor, Austin Goolsbee, Chicago Fed, is actually saying the credit markets are tightening up here, and they're doing a lot of work for the Fed in terms of slowing things down. Someone on the Fed who is, willing to go out and kick the tires and try and figure out what's really going on out there. So that's good news. One of the other pieces of good news from a monetary policy point of view is that Canada, Australia, India, and Singapore, I think this past week, have all gone on hold. And so they're looking at something concerning, and my guess is it's very serious downturn and price deflation in a lot of trade indicators, which will come back to us.